Hey everyone, welcome to this explainer. Today we're going to map out the hidden plumbing of global finance, the primary versus the secondary markets. We constantly hear about trillions of dollars flowing through the financial system, right? We see those ticker symbols flashing green and red on our screens, and we're always hearing about markets going up and down. But today, we're going to step right past those flashing lights. We need to understand the core mechanical differences between the two environments that literally make the entire global economy possible. We're going to sketch out exactly how capital is actually raised and how liquidity is maintained. Okay, let's dive into this. When you buy a stock, where does the money actually go? Seriously, I want you to think about it for a second. If you pull out your phone, log into your brokerage account right now, and buy 10 shares of your absolute favorite tech company, does that company get a notification? Do they take your cash and use it to, say, build a new factory or hire a new lead engineer? For a lot of people, the assumption is, well, yeah. We tend to think that investing in a company means handing our money directly to them. But in the vast majority of cases, that assumption is entirely wrong. In the real world of global financial operations, the ultimate destination of your cash depends entirely on which market you are operating in. To make this crystal clear, let's actually think about cars for a minute. It is honestly the perfect metaphor for how these financial markets work. Imagine you want a brand new car. You walk into a dealership, you pick out a pristine vehicle with 0 miles on the dash, and you hand over your check. In this scenario, your money goes straight back to the manufacturer. It pays for the steel, the factory labor, the R&D for next year's model, and of course, the company's profit. But now, imagine you buy that exact same model of car, but it's a year old and you buy it off some guy you met on Craigslist. The car itself? Structurally identical. But where does your money go this time? It goes straight into the pocket of the person selling it to you. The original manufacturer doesn't see a single cent of that Craigslist transaction. The physical car is exactly the same, but the flow of cash is fundamentally different. And this brilliantly illustrates our first major financial venue, the primary market. Basically, this is the venue where issuers bring brand new securities to the market for the very first time. The entire purpose of this market, its reason for existing, is to raise capital. When a security is sold here, the money flows directly from the investor into the bank account of the entity that created it. This is the one and really the only time that the creator of the asset actually gets paid for it. They are the dealership. So who exactly are these financial manufacturers looking for all this cash? Well, we call them issuers, and they generally fall into a few massive buckets. First, you have corporations. They might need billions to expand globally or fund some huge research and development project. Then you have governments. This could be local, state, or national, who issue bonds to do things like build highways, fund schools, or just manage the national debt. And finally, you have supranational organizations like the World Bank, who are raising funds for massive global infrastructure projects. Whenever these giant entities need fresh capital, they can't just swipe a credit card, right? They have to actually manufacture a brand new security and sell it on the primary market. I actually like to think of this as the high-stakes birthing process of a security. It is a major event. When a corporation wants to issue new stock to the public for the very first time, we call this an initial public offering, or an IPO. You've definitely seen the footage of those executives cheering and ringing the opening bell at the stock exchange. That right there is the climax of an IPO. Now, for governments and debt instruments, this birthing process usually takes the form of a bond auction. These are massive, highly coordinated events where big institutional buyers bid on newly minted bonds. It is the exact moment a financial instrument officially comes into existence and fresh capital is injected straight into the issuer's hands. But what's going on behind the curtain? While the executives are out there popping champagne, the operations teams in the back office are executing a highly precise, high-pressure sequence of events. It's intense. First up, they're managing the prospectus details, making absolutely sure every single legal and financial disclosure matches perfectly with what is actually being sold. Then, they are meticulously tracking application closing dates. In a primary issuance, there are hard, unforgiving deadlines. If a buyer's application isn't processed by the cutoff, they simply don't get the new shares, period. Finally, the ops team has to secure the exact payment amounts, because this is the very moment the company is getting funded. Millions or even billions of dollars must be accurately calculated, captured, and routed directly to the issuer's accounts. Okay, let's move on and see how this built. What happens the day after the IPO? The executives have all gone home, the issuer finally has their capital, and the investors now hold their brand new shares. The primary market event is officially over. But, the life of that security has just begun. It leaves the dealership and it enters the wild, high-speed environment where the rest of us actually interact with it. Welcome to the secondary market. If the primary market is the new car dealership, the secondary market is basically the world's largest, fastest Craigslist for financial assets. It's the marketplace for trading existing securities. I really want you to focus on that word right there, negotiable. Negotiability is the absolute magic of the secondary market. It means that once a security is born, it can be freely traded, bought and sold between complete strangers over and over again without ever needing a single ounce of permission from the original issuer. So the crucial point is, who gets the money? Well, in the primary market, your investment funds the company. But in the secondary market, your investment just funds another investor. When you hear on the news that a stock's price surged 20% today, that is purely secondary market action. That surging price reflects the market's perception of the company's value. But here is the mind-bending part. That huge price jump doesn't add a single cent to the company's actual bank account. Just like a used car selling for a crazy premium doesn't help Ford or Toyota, a stock trading at all-time highs only enriches the current owner of that stock, not the company that originally issued it.
Now, what's really interesting about this is how we contrast the ways this trading actually happens out in the real world. We basically have two distinct environments. On one side, we have on-exchange trading. Think of the New York Stock Exchange or the London Stock Exchange. These are highly formalized, heavily regulated environments. Trading here is order-driven, meaning buyers and sellers submit their orders into a giant centralized computer system that matches them up based on strict, predefined rules. On the flip side, however, we have over-the-counter or OTC trading. This is a massive, completely decentralized network. There is no physical exchange building. Instead, trading happens directly between counterparties over the phone or through proprietary electronic networks. It's a bit like the Wild West compared to the strict order of the exchanges, but a massive, massive portion of global finance flows through these OTC networks every single day.
And just like the primary market, the secondary market has its own operational marathon happening behind the scenes. Except here, it's not a one-time birthing event. It happens literally millions of times a day. Step 1 is trade capture. The absolute instant a buyer and seller agree on a price, that data must be accurately recorded by both sides. Step 2 is instruction matching. The buyer's broker and the seller's broker send their electronic instructions to a clearinghouse, and those instructions have to match perfectly. I mean, down to the penny and the decimal point. If they don't match, the trade breaks. Finally, if everything aligns, we move to Step 3, CSD settlement. This is the final, actual exchange of cash for the security. And that brings us to the ultimate finish line of every single secondary market trade, the Central Securities Depository, or the CSD. You can think of the CSD as the master electronic ledger of truth. It is the definitive record of exactly who owns what at any given moment. When a trade settles, the CSD updates its database. It deducts the security from the seller's account and credits it to the buyer's account. Until that CSD is updated, the trade is honestly just a promise. The update at the CSD is what officially, legally transfers the ownership of that used asset. Let's pull all of this together. As you look at this ecosystem, you realize pretty quickly that neither market can survive without the other. It's a perfect symbiosis. Companies absolutely rely on the primary market. Without it, they couldn't create the capital they need to build factories, hire workers, and actually drive economic growth. But on the other side, investors demand the secondary market. Why? Because it provides liquidity. It gives them an exit strategy. It guarantees that if you buy a stock on Monday, you can turn right around and sell it for cash on Tuesday. Which leads me to one final, somewhat radical thought. If the secondary market completely vanished tomorrow, like if all the exchanges shut down and all the OTC networks just went dark, what would actually happen to your primary investments? Well, the answer is pretty terrifying. You'd be stuck holding an asset you could never sell. Your money would literally be trapped forever. And knowing that, would you ever buy a new stock in the primary market again? Probably not, right? And that perfectly illustrates the hidden genius of this whole engine room. The fast-paced, sometimes chaotic trading of the secondary market is exactly what gives investors the confidence to fund the real-world growth of the primary market. Definitely keep that in mind the next time you see the markets moving. Thanks for joining me for this explainer. I'll see you next time.